Stocks see all-around selling with declines outnumbering advances by a wide margin. The global uncertainty coupled with the deadline for compliance with the SEBI disclosure norms for high single stock exposure by FPIs weighs on sentiment. A large trade of 1.2 crore shares accounting for nearly 25% of the Indigo Paints equity changes hands in a transaction worth about 1,800 crore rupees. Large private equity investor Peak XV Partners is the likely seller. Minister of Petroleum and Natural Gas Hardeep Singh Puri says transitioning to clean fuels is crucial, but diesel remains an important component and the government won't up taxes on fossil fuels. The Reserve Bank of India has added 5 tons of gold to its kitty in July after adding the yellow metal to its coffers each month in 2024. The addition this year now stands at 43 tons, taking its total holdings to 846 tons. Hello and welcome to Business Lunch this Friday afternoon here on CNBC-TV18 in the Mumbai News Centre. I'm Hormuz Fatakia. Let's first take a look at how the markets are faring. Well, the city is gearing up for festivities, but, well, the markets don't reflect that sentiment. In fact, now, after a brief recovery that we saw from the lows of the day, we are back to those levels now. At the lowest point of the day is the Nifty, nearly 300 points down now on the index, nearing levels of 24,850. So any hopes of the index closing with the positive territory now seem bleak, with just a couple of hours left now for the trading session, and the index now is down well in course for the week as well. The Nifty Bank as well is seeing some bit of selling pressure now, 650 points down on the Nifty Bank. The Wix has seen a bit of a spike as you just saw on your screens, but the Nifty Bank, that was the one that was supposed to take the index higher, but is seeing some bit of selling pressure today as well. Actually, a lot of selling pressure now at the lowest point of the day, 58.25 on the Nifty Bank, and that comes with selling pressure seen on State Bank of India, the top loser on the Nifty index. The India's largest lender got a downgrade today from Goldman Sachs. Price target cut as well. That down to the lowest point of the day as well. 4% lower now on SBI, below levels of 800. Losses coming from Reliance Industries as well. Second straight day when it is leading the losses today on the Nifty. Yesterday also was the top contributor to the downside. Today as well, the losses coming from SBI, ICICI Bank, ITC. ITC was one of the gainers in yesterday's session, given up all those gains and now contributing towards the downside. What's holding up? Paint companies, the oil sensitives, HUL and Bajaj Finance seeing some bit of gains, but pressure also is seen within the PSU basket. The Nifty PSE index is seeing some bit of selling pressure in today's session. It's down for the third straight day today and down over 3% this week. Now, there's some bit of recovery from the lows of the day. At one point was down 2.5%, the PSE index, but the index is down 3% this week, the worst weekly performance for the index in over 2 months. But what may be the key reason for this downtrend? One of those at least. Nimesh is here to highlight those details. Nimesh.
One of the reason is that there was a SEBI circular on the FPIs way back in August 23, and again the circular very clearly said that any FPI who owns who has an exposure of more than 50% in a single stock or more than 50% in a single group company or having an AUM of more than 25,000 crores, in that case they will have to disclose the very last user as well to the regulator. If not so, then they'll have to trim down the position to less than 50%. That was the circular which was passed on. Now, today technically is the last day to comply with that circular. If not, then the FPI has to sell the position or trim down the positions. Now, there is also provision that for the next 6 months they can continue and sell over the next 6 months. But in that case, there is a 5% penalty clause on the sale value, which means that even if you've bought, like said, X price and sold at a Y price, it's not the profit, but it's the entire sale value on which you'll have to pay 5% is the penalty that the SEBI had put out the circular. So it's a bit complicated, but this is one of the reasons what I picked up from my sources, that maybe it's putting some pressure on some individual names in today's market. Now, the other side of the feedback is that any which ways, the total exposure of these FPIs through this particular vehicle or that exposure of more than 50% in a single stock or in a single group seems to be quite small. So it's not going to have a big impact on the overall markets. But technically, for the fact that today is the last day to comply with that compliance, maybe some stocks are under pressure today, and that's what a lot of dealers are attributing to one of the reasons why the markets are under pressure today.
Nimesh, thanks a lot for that. The market then heading towards the lowest point of the day. But has the RBI governor hinted at a change in stance? Now, that's the doubt nagging the bond market after the governor's speech at the FIBAC yesterday. The words mentioned by the governor are the balance between inflation and growth is well poised. Lata is here to explain why the market is excited about this sentence in the governor's speech.
The governor's speech at the FICCI IBA conference was an interesting one, but this sentence didn't make headlines. Because when you say it, it doesn't sound that important. The balance between inflation and growth is well poised. But later the speech was put on the website, and I want to bring your attention, if we can get the picture of that quote itself. This one line has been put in bold. Now you can see. The rest of the sentences are okay, but the balance between inflation and growth is well poised, is put in bold. Is the governor, highlighting that to say that we are in a neutral stance? And, in the previous instances, for instance, in the monetary policy of August 8th and in the minutes, whenever such sentences have come, they've been followed up by saying that food inflation is still very high. But those sentences are importantly absent in this paragraph. And the possibility is that the Reserve Bank is veering around to the idea that the monsoon has been excellent, the second half, probably the La Nina effect, and therefore the second quarter CPI number, which the Reserve Bank had upped from 3.8 to 4.4, is not going to be 4.4. It is going to come closer to 3.8% or maybe at 3.8%. So it is undershooting the Reserve Bank's forecasts. Also, moving away from food, the extent of Chinese slowdown and disinflation in several commodities is likely to keep our core inflation, core CPI, continue to remain around that 3% mark. Now, in terms of liquidity, the Reserve Bank has already restored liquidity. Liquidity was tight a year ago. Now, the banks are not going and borrowing from the Reserve Bank as much. It's only on a straight day. So this withdrawal of accommodation stance perhaps has to go. Is that what the governor is trying to say in his speech, that the withdrawal of accommodation stance in the upcoming monetary policy, that is on October 8th, will change to neutral? That is what is bugging people in the bond markets. They didn't find that when the speech was made yesterday. But when you saw the printed copy and the bold letters, then there is a very clear expectation that they'll change the stance to neutral in the October policy, and that paves the way for a rate cut sometime soon.
Lata, thanks a lot for that update. Now, time for a short break here on Business Lunch. On the other side, we put the spotlight on the credit deposit ratio of banks in our special segment, FinStreet. Welcome back. Now, global central banks are on a gold buying spree, purchasing 43 tons of the yellow metal in July itself. Manisha Gupta is joining in to tell us more. Well, Manisha, it seems like the central banks are looking to pile on to the glitter as well.
Oh, well, yes, and why shouldn't you then? If you look at the global markets numbers, really, Hormuz, that tells you that the global gold ETFs are on being bought 4 straight months, if you count the month of August as well. And well, yes, the global central bank gold buying has been one of the reasons that the gold prices have continued to be where they are right now. Of course, add geopolitics and the fact that the US rate cuts are into the coming there. So when you look at the India's RBI as well, we have added 5 tons to the gold reserves for the month of July. And when you look at this current year, well, India's RBI has bought gold every single month in 2024, bringing that count really to around 43 tons. If you look at the overall India gold reserves, when it comes to gold reserves into the RBI, they stand at a tall 846 tons. So there has been a very strong buying that we have seen continuing. It actually has been 8 to 10 countries which have been constantly buying, including China, various other Asian countries, and of course within the UAE markets as well. The global central bank buying has been on the stronger side, even as the gold prices have been hitting all-time highs there. So when you look at the month of July, it has been at to the tune of around 37 tons. For the month of June was at around 12 tons. So we have seen almost 200% of a jump up coming in there. Also, when you look at the first 6 months of the year that the global markets have bought gold, it has been at an all-time highs. In the year 2022 is when the global central bank buying was at an all-time high of 1,087 tons. 2023 saw a buying of around 1,037 tons, and in this year until now we've seen more than 500 to 600 tons being bought by global central banks. It still is 5-6 months remaining, and the expectation is that we could be looking at a higher number. Citi, Bank of America have put out 1,100 tons being bought by global central banks as an expectation for this year. So while continues to be a very strong one, it has been an active accumulation, whether it is about geopolitics, de-dollarization, or about increasing their reserves when it comes to gold, but it clearly seems to be helping the gold prices within.
It's certainly helping the prices indeed. Manisha, thanks a lot for that. Time for an exclusive now. Sources are saying that tweaks are being sought on the project financing rules by the IBA and the government, along with suggestions for a deferred and staggered rollout of the expected credit loss norms. Sapna Das has the details. Sapna, what are your sources telling you?
Well, first of all, in terms of the project finance rules, the draft rules are out in the public domain by the Reserve Bank of India, put out quite some time back. So here, both the banking industry as well as the government as important stakeholders to this entire matter, some suggestions have been made to the regulators. What we are given to understand is what sources are telling us. So, of course, first of all, the 5% norm that we are talking about, well, there is an across-the-board opinion within the industry and within other stakeholders that this is too steep. Not only will it cause higher provisioning in terms of, the cost of financing going up for such projects, but this could also impact credit flow to important infra sectors. So this is one element that, suggestions have gone to the regulator in terms of trying to tone it down. That's one. Second, also in terms of, the higher provisioning norms does not make a sectoral differentiation. Whether it's ports or roadways or, maybe a renewable energy project, all of them are being suggested that they should be at 5% provisioning norm during the construction course. And at the last event, 5% is what the norm that is being suggested by RBI. So there is no sectoral differentiation, so to speak. Not every sector has the same risk assessment. So suggestions have also been made on this front that maybe a relook or a rethink may be required at the banking regulators' end. Third, in terms of the credit event basically relates to the possibility of defaults under such project finance, under such projects. Now, here also, the suggestion as per the RBI draft indicates that an independent re-evaluation will be required. Now, this could basically trigger restructuring of such projects in case there are signs of distress, there are signs of credit impairment. And this is how a credit event has been described. And this has to be done on an annual basis by the bank. So this could be quite cumbersome and it will have some other fallout as well. All of these things put together, there is a concerted effort both by the banking industry and probably even the government in trying to convince the Reserve Bank to do some kind of a rethink on some of these key aspects. Last but not the least, there is also a discussion paper that had been put out by RBI sometime last year in terms of the expected credit loss provisioning norms. Now, that's still a discussion state, but here too we are given to understand that some additional time, may have already been sought for banks to basically align to this as and how the RBI is ready with those guidelines.
Sapna, thanks a lot for that update. Now, the slowing growth in Indian bank deposits compared to credit in recent times has been a cause of concern. Abhishek is joining in with a complete analysis of the credit deposit ratio in the banking sector over the last 2 quarters.
Well, in December 2023, CNBC-TV18 had reported that certain lenders have been asked by RBI to curtail their credit deposit ratio to around 75% levels. Now, RBI highlighted this as a caution to the banks given the fact that high credit deposit ratio may put financial system liquidity at risk. It is imperative that banks have prudent liquidity management measures and credit growth should not outpace deposit growth by miles. Banks have been witnessing a 300 to 400 basis point gap between deposit growth and credit growth. So it has been observed for the last few months that deposit growth has been on a declining growth rate trend. It is a kind of cautioning for the bank's management that going forward, this may create structural issues with regard to liquidity management as well. If it goes unattended, it can lead to a potential structural liquidity management issue in the system as well. RBI has said banks with the wide branch network are expected to come out with innovative products and services to mobilize deposits. Huge bulk deposits have always been a lazy banker's job. RBI Governor has said that share of CASA in the overall deposit, which was about 43% a year ago, has come down to about now 39%. Therefore, banks need to focus on these retail deposits as well and not just some bulk deposits for growth. Let's take a look at the impact of CNBC-TV18 story. From Q3 of FY24 to Q1 of FY25, now CD ratio, that is credit deposit ratio in the banking segment, has declined from 82.3% to 81.6%. This number excludes AU Small Finance Bank because it saw a merger that has happened. Now, out of 39 lenders, 24 of them have seen a decline in their credit deposit ratio. So, as I said earlier, we are not considering AU Small Finance Bank because Fincare Small Finance Bank got merged with AU Small Finance Bank in Q1 FY25. The highest credit deposit ratio decline over the last 2 quarters has been for Jana Small Finance Bank, IDFC Bank, Equita Small Finance Bank, Suryodaya Small Finance Bank, HDFC Bank, Utkarsh Small Finance Bank, as well as Bandhan Bank. Now, CD ratio has improved over the last few quarters for banks like Capital Small Finance Bank, Punjab and Sindh Bank, State Bank of India, as well as UCO Bank. Lowest CD ratio in the banking sector, that is below 71%, we have seen for Central Bank of India, Punjab National Bank, IDBI Bank, UCO Bank, as well as Punjab and Sindh Bank. If you take a look at the highest credit deposit ratio in the banking sector, which is more than 90%, is for banks like Suryodaya Small Finance Bank, HDFC Bank and Utkarsh Small Finance Bank at 103.5%, Jana Small Finance Bank, IDFC First Bank, Bandhan Bank, ESAF, Equitas, Ujjivan, as well as Axis Bank. In terms of outlook ahead, there is still a huge headroom for declining credit deposit ratio of many lenders to RBI's comfortable level. This can further create pressure on net interest margin due to high interest rate on the deposit side that we are witnessing in the system. Lending opportunities on higher yield products like unsecured loans is declining. Now, with RBI cautioning on unsecured loans, also the fact that it will impact the yields of the banks. Decline in CD ratio may lead to efficiency in the system, like focus on retail deposits than bulk deposits for growth as well. Bankers do say that if the situation doesn't improve in the next 6 months, it will start impacting the net interest margin.
Abhishek, thanks a lot for that. Time for a short break. More news and updates follow on the other side. Stay tuned. Welcome back. Let's shift focus to some global macro cues now in an exclusive conversation with CNBC. American economist and Nobel laureate Joseph Stiglitz said that he believes the Fed's policy has added to the problem of housing inflation and added that he would vote for a 50 basis points rate cut in September. Listen in.
I believe that they have contributed to the problem of inflation. Now, even though their models don't work this way, and they're not looking at things, I think, as deeply as they should, their models tell them, look at the weaknesses in the economy, and therefore we should be lowering interest rates. So I would vote for a bigger rate cut because I think they went too far, and it would actually help on the issue of inflation and on jobs.
Now, Stiglitz also gave his outlook on the U.S. economy under the next potential U.S. presidents, Donald Trump and Kamala Harris, and explained why he wouldn't want someone like Donald Trump giving the Federal Reserve orders. Listen in.
There's been a large increase in market power, in concentration in our economy over the last 20 years, and we're finally, under Biden, beginning to attack that. There's no comparison between the nature of the debt that will emerge if Trump is successful and Harris's. Trump has promised massive tax cuts for the corporations, large tax cuts for wealthy individuals, the magnitudes of the deficits that will result will be in the trillions of dollars, several times the increase in deficits that will result from the kinds of proposals that Harris puts forward.
And that's a wrap on this edition of Business Lunch from me and the team that put this show together. Thank you so much for watching. Midcap Radar comes up next.